Welcome back to Charged Alpha Podcast, the show that breaks down S&P 500 earnings, one ticker at a time. Today we are diving into one of the strangest, most explosive industrial stories on the entire market.
That is right, Hudson. We are talking about Comfort Systems USA, ticker FIX, a Houston-based mechanical and electrical contractor that just printed an absolutely stunning first quarter 2026 result yesterday afternoon.
Revenue blew past consensus by nearly 20%. GAAP earnings crushed estimates by 54%. And the stock now sits at $17.74 after a 400% run from its low.
We will walk through the full 8-quarter trend, decompose the GAAP versus adjusted earnings gap, examine margins, balance sheet strength, capital allocation, valuation, peer comparison, and segment-level dynamics in detail today.
This is a name that has gone from sleepy mechanical contractor to one of the most controversial high-multiple industrials on the entire market. And the first quarter print only intensifies that debate further.
Comfort Systems USA traces its roots to 1917, but the modern company was assembled through a roll-up of regional mechanical contractors, and today serves commercial, industrial, and increasingly mission-critical data center customers.
Headquartered in Houston, Texas, the firm is led by Chief Executive Brian E. Lane, who took the top job back in 2016 and has overseen this remarkable transformation into a data center infrastructure powerhouse.
The workforce has scaled to roughly 22,700 employees across the United States, installing HVAC, piping, plumbing, power distribution, and electrical panel systems for some of the largest construction projects in the country.
The business splits into two segments. Mechanical contributes about 75% of revenue, while electrical adds the remaining 25%, and both segments are riding the artificial intelligence build-out wave hard.
Market capitalization currently stands at $62.4 billion on roughly 35.2 million shares outstanding, with a beta of 1.6 reflecting elevated sensitivity to broader industrial cycle moves.
The 52-week range tells a story all by itself. The low was $355, the high is $17.99, and the stock now trades within $25 of that high.
It sits inside the S&P 500 industrials sector, classified within engineering and construction. But make no mistake, the real driver here is hyperscale data center demand for advanced cooling and power infrastructure.
Let us walk through the 8-quarter revenue trajectory because this chart is genuinely jaw-dropping. Back in second quarter 2024, Comfort Systems generated $1,810 million, a perfectly respectable industrial number.
Third quarter 2024 came in at $1,812 million. Then, fourth quarter 2024 climbed slightly to $1,867 million, showing steady but unspectacular sequential growth across that earlier period.
First quarter 2025 actually dipped to $1,831 million, which at the time looked like potential deceleration. But with hindsight, we now know that was the calm before a massive storm.
Then, second quarter 2025 jumped to $2,173 million. Third quarter accelerated to $2,451 million, and fourth quarter pushed all the way to $2,646 million.
And the just reported first quarter 2026 number landed at $2,865 million, marking the 8th consecutive quarter of meaningful revenue beats above Wall Street consensus expectations.
That works out to 56.5% year-over-year revenue growth, which makes Comfort Systems one of the fastest-growing industrials anywhere in the entire S&P 500 index right now.
For an engineering and construction firm to compound at that rate is essentially unheard of. This is software company growth dressed up in a hard hat and steel-toe boots.
The data center cooling and electrical demand is the obvious catalyst, and the multi-quarter backlog gives management confidence that this is structural rather than a one-quarter spike in activity.
Sequential growth from fourth quarter 2025 to first quarter 2026 was about $219 million, or just over 8%, which is remarkable considering the first quarter is seasonally the weakest period. Now let us pivot to the earnings line, because this is where the story gets nuanced. GAAP earnings per share came in at $10.51 versus consensus of $6.81.
That is a beat of $3.70, or roughly 54% above where the street was modeling, continuing an extraordinary streak of triple-digit percentage earnings outperformance over the last several quarters.
But here is the wrinkle. Adjusted earnings per share actually came in at $6.66, slightly missing the $6.81 consensus by 15 cents, or about 2.2% below.
That GAAP versus adjusted GAAP likely reflects amortization of acquired intangibles from recent merger and acquisition activity, which on a cash basis is a non-issue but creates real reporting noise for analysts.
GAAP earnings per share grew 121% year over year from $4.75 in the prior year quarter, while consensus was modeling growth closer to 40%.
Looking at the trailing 8-quarter pattern, GAAP earnings have moved from $3.74 to $4.09, $4.09, $4.75, $6.53, $8.25, $9.37, and $10.51.
Every single one of those quarters beat the consensus estimate by a meaningful margin, and that history matters when we think about any forward EPS projection coming out of Wall Street analyst models today.
Consensus currently sits at $36.60 for full year 2026. But given the 30 to 54% beat history each quarter, the real number could land far higher.
If data center wins continue at the current pace, our forward EPS projection range could realistically hit $45 or more this year, which would dramatically reset the valuation conversation we are about to have.
Margins tell the same bullish story. Gross margin in the first quarter hit 26.3%, which is the highest reading in the entire 8-quarter trend we just walked through.
Trailing 12-month gross margin is sitting at 25.1%, so first quarter is meaningfully accretive and signals that mix shift toward higher margin work is genuinely accelerating across the project portfolio.
Operating margin came in at 17.0%. Also the highest in the series, with net margin at 12.9%, both reflecting strong operating leverage from the rapid revenue scale up.
The driver is mix shift toward data center and mission-critical projects, which carry premium pricing because the engineering complexity and execution risk are significantly higher than standard commercial HVC and electrical installation work.
This is exactly the kind of margin expansion bulls want to see alongside revenue growth, because it shows Comfort Systems is not buying market share with discounting, but earning it through specialized capability.
The combination of revenue compounding above 50% and gross margin expansion of more than 100 basis points is the textbook signature of a business with genuine pricing power in its end market. On the cash flow side, operating cash flow in the first quarter came in at $389 million, which is seasonally softer than the back half of last year by design.
For context, third quarter 2025 operating cash flow was $462 million, and fourth quarter pushed to $513 million, so the first quarter dip is timing rather than fundamental weakness.
Capital expenditures came in at $147 million, up roughly 40% year over year, reflecting heavy investment in capacity, equipment, and field workforce expansion to support the surging backlog.
Free cash flow landed at $241 million, which fully funds growth investment, the dividend, and any tuck-in acquisitions without ever touching the cash pile sitting on the balance sheet.
The CapEx acceleration is something investors should monitor closely. Rising capital intensity is normal during hypergrowth phases, but it can pressure free cash flow conversion if revenue growth ever starts to slow meaningfully. That balance sheet is genuinely fortress grade. Cash sits at $1,050 million against total debt of just $339 million, leaving a net cash position of $711 million.
Total assets stand at $6,938 million, with total equity at $2,815 million. And trailing 12-month return on equity is an absolutely remarkable 41.8%.
A return on equity above 40% for an engineering and construction firm is essentially unprecedented and tells you the business is generating massive economic value relative to the capital invested.
On the dividend side, the annual payout is $2.25, paid quarterly at 56.25 cents, yielding just 13 basis points at the current share price.
That yield is essentially zero, which makes one thing very clear. Nobody owns Comfort Systems USA for income. This is a pure growth story dressed up with a token capital return program for show.
There is no meaningful share buyback program either, which is consistent with management prioritizing reinvestment into the business rather than financial engineering or returning capital to shareholders during this exceptional growth window.
With a net cash position of $711 million and no leverage to speak of, the balance sheet provides genuine optionality during any future economic downturn or industry capex slowdown that may emerge. From a capital allocation lens, the playbook is clear. Reinvest aggressively into capacity, fund tuck-in acquisitions of regional mechanical contractors, and let the net cash pile grow as a strategic optionality reserve.
Management has historically used small bolt-on M&A to expand geographic footprint and add specialty capabilities, and with $711 million in net cash, they have plenty of dry powder available.
The lack of buybacks is notable for a stock up 400% from its low. Management is signaling they would rather invest in the business than chase the share price higher.
That kind of disciplined capital allocation tends to pay off over very long periods. But it does mean shareholders should not expect any near-term boost from share count reduction or special distributions. Analyst coverage on this name is genuinely shocking. Despite a $62.4 billion market capitalization, only 3 Wall Street firms actively cover Comfort Systems USA with published research and price targets.
Those 3 firms are D.A. Davidson, Stifel, and UBS. All 3 currently rate the stock a buy. There are 0 hold ratings and 0 sell ratings across the entire analyst community right now.
The average 12-month price target is $1,850, which implies just 4.3% upside from the current $1,774 level, meaning the stock has essentially run past targets.
That undercoverage is itself a thesis element. A $62 billion S&P 500 company with only 3 analysts is dramatically underfollowed compared to peers of similar size in the industrial complex.
New analyst initiations could swing the stock meaningfully in either direction, and that asymmetry is something both bulls and bears need to keep on their radar through the rest of 2026.
Frankly, the fact that no major bulge bracket bank has launched dedicated coverage on a $62 billion S&P 500 industrial is one of the most unusual setups we have seen in a while. Let us tackle valuation, because this is where the debate gets really interesting. Trailing 12-month price to earnings is 51 times, with forward price to earnings at 48.5 times.
Enterprise value to EBITDA sits at 23 times, price to sales at roughly 6 times, and price to book at a stunning 22 times, all well above historical industrial averages.
For context, the broader engineering and construction sector trades around 14 to 16 times EV to EBITDA, so Comfort Systems carries a meaningful premium of 7 to 9 multiple turns above peers.
That premium reflects the artificial intelligence data center growth optionality, plus a remarkable consistency of execution. But it also demands continued execution, because any deceleration triggers immediate multiple compression risk.
Even using a more aggressive earnings estimate of $45 instead of consensus $36.60, the multiple would still be near 40 times, well above where industrial cyclicals typically clear historically.
Bulls argue the multiple is justified by structural data center growth, while bears counter that even the most exciting capex cycles eventually end, and the multiple has to compress when growth normalizes lower. Speaking of peers, let us walk through the comparable basket. Comfort Systems trades at 51 times trailing earnings, the absolute highest multiple in the entire mechanical and electrical contractor peer group.
Quanta Services, ticker PWR, sits at 43 times. MCore Group, ticker EME, trades at 35 times, while API Group, ticker APG, comes in around 28 times trailing earnings.
Mastech, ticker MTZ, is the cheapest of the bunch at 25 times, roughly half the multiple of Comfort Systems, despite operating in adjacent infrastructure and utility construction end markets.
All five names compete for similar talent and infrastructure projects, but rivals like EMCOR and Quanta have broader exposure to utility and telecom work rather than the pure data center mix that Comfort Systems enjoys.
That mixed difference is exactly why the market awards the fixed premium. Investors are explicitly paying for concentrated artificial intelligence and hyperscale exposure without the dilution of slower-growing legacy infrastructure end markets.
Quanta is the closest comparable from a growth premium standpoint, but its electrical grid focus tilts the business toward utility CapEx cycles rather than the much faster-moving hyperscale data center construction wave. Drilling into segments, the mechanical business contributed approximately $2,149 million in the first quarter, representing 75% of total revenue and almost all of the year-over-year growth.
Mechanical includes HVAC, piping, and plumbing systems, and it is the primary beneficiary of the data center cooling boom because every hyperscaler facility requires massive thermal management infrastructure to operate reliably.
The electrical segment contributed roughly $716 million, or 25% of revenue, focused on power distribution and panel installation for commercial, industrial, and increasingly mission-critical facilities and campuses.
Both segments benefit from the AI CapEx wave, but mechanical is clearly leading because cooling demand scales non-linearly with chip density, and modern AI accelerator racks are pushing thermal loads to unprecedented levels.
Comfort Systems has spent years building specialized expertise in liquid cooling, prefabricated mechanical modules, and rapid deployment construction techniques that hyperscalers genuinely value when racing to bring new data centers online quickly.
That specialization creates a real moat because hyperscalers tend to consolidate work with proven mechanical contractors who can execute at scale rather than parceling out projects across many smaller regional players with limited track records.
Management commentary from Chief Executive Brian Lane reinforced the structural nature of the demand, with him explicitly stating that the backlog gives confidence this activity is not a one-quarter event, but a multi-year wave.
Let us close with the bull and bear cases. The bull case rests on 56% revenue growth, a fortress balance sheet with $711 million in net cash, and structural AI CapEx tailwinds.
The bear case is equally clear. 51 times trailing earnings demands flawless execution. The adjusted EPS slightly missed consensus, and the stock sits within $25 of its all-time high.
There is also concentration risk in artificial intelligence CapEx. If hyperscalers slow data center construction even modestly, the primary growth engine stalls, and that 51 times multiple compresses very quickly toward peers.
Our take is that this is one of the highest quality industrial stories on the market today, but valuation requires investors to underwrite continued execution, and entry point matters enormously at these levels.
Watch the next quarter for any commentary on backlog conversion, hyperscaler order patterns, and adjusted EPS trends, because those are the variables that will determine whether the premium multiple holds or compresses.
For long-term holders who already own the stock, the playbook is to monitor execution, watch for any deceleration in revenue growth, and reassess if the gap between GAAP and adjusted earnings widens further.
For potential new buyers, dollar cost averaging into a position would help manage the entry point risk given how close the stock currently sits to its all-time high after such an extraordinary run.
That wraps our deep dive on Comfort Systems USA, ticker FIX, for the first quarter 2026 earnings report. Thanks for listening to Charged Alpha, and Lana will take us out with the disclosure.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.